All right, are we ready to get started? You excited? All right. All right, I'll give a few starting out thoughts. In general, we're talking about the intersection of what may be traditionally nonprofit or charitable values and investments. Heard a number of people say that we tend to be of two minds and sometimes two pocketbooks. On one end, when we think about charity and we're thinking about what we're giving to, we're 100% values driven. We give to what we care about. And then on the other side, our other pocket, our other mind, we're investing, and we sometimes only think about what is the return. I think what we want to explore tonight, what we're already doing, is where do those two kind of intermingle? And in some ways, how do we do those at the same time? Integrate our values into our investments in the same ways we might do it with our charity. Besides working with Weave Social Finance, some consulting on affordable housing and project finance for clean tech and green tech companies, mostly in the rural South. But I also started Impact Charitable, which has been mentioned a few times. We offer donor advised funds that activate dollars set aside for charity to do impact investing. And that can include investments in the public markets as well as investing in local companies like those who pitched here, or not so local, but all investing in impact with those dollars, which we think is a unique set of money that has no time horizon. It has no purpose in the future other than to go to charity. So you can particularly align that investment with your values through a donor advised fund. So we'll go ahead and go with the panel. I think we'll just go through them. I'll let them each introduce themselves and tell a little bit about their particular project that blends these two nonprofit and for-profits together in a lot of different ways. So all four of these folks are very innovative in what they're doing. We'll start on the end with Rich Hoops with Impact Academy.
Good evening, everybody. You just introduced me, so I don't need to do that.
That's right.
The hat I'm wearing tonight is as the co-founder and board chair of Impact Hub and Impact Hub Academy. Some of you know about the Impact Hub in Boulder. It's an impact-focused collaborative work meeting and event space. We're a member of a worldwide network of over 100 of these around the world. But about 6 years ago, a group of us got together and wanted to bring the Impact Hub to Boulder and created an LLC to do that because we wanted to prove that you could make money and make an impact at the same time. So we have a group of 20 or so investors. And like a lot of startups, we've pivoted about every 6 months. And the Impact Hub its business model has always been a kind of a hardware plus software business. The hardware being the space, much like the Alliance Center. So we sell memberships, we rent offices, you can rent the space for events, that sort of stuff. And then we overlay programming on top of that. And what we found is as we were trying to kind of maximize both kind of impact and financial return, our software side of the business was challenging. It was actually dragging on profits. And it's not this phenomenon isn't unique to us. I do quite a bit of impact investing in early stage companies. And there's a number of them who start off with just a pure kind of for-profit model, but along the way, kind of identify an opportunity to leverage legal structures, which are simply tools that allow you to try to achieve an objective. So what we did is we about a year ago, we created a 501c3 that acts as a tandem organization so that we could continue to run some of the software, the programming side, whether it's workshops, events. We're running a really innovative program starting in January in Boulder, working with the city on climate change, and tap into philanthropic funding for that. I think just in general, one of the things I've seen in the last 7, 8, 9 years I've been involved in impact investing is, as Ed mentioned, where we used to always think about, either for-profit, nonprofit, and philanthropy and investment as just black and white, and there was a wall in between. We're recognizing that there really is. It's all capital, and it all has leverage in certain circumstances, and also with the legal structures. And of course, now you've got L3Cs and benefit corps and B corps. So as people who want to invest money and use our money to make an impact and financial return, the options we have many more creative options. We've been operating the nonprofit side of the Impact Hub now for a year, and it has absolutely proven to be the best way to do this. This hybrid structure that we have is not only allowing us to tap into philanthropic funding to do much more highly impact focused programming, but it's actually benefiting the for-profit in a number of ways. So actually, we're getting leverage out of both.
Yeah, I think that's one of the problems we've talked about in impact investing often, that in the normal market, sometimes some companies are financially rewarded for externalizing their social or environmental benefits. That's not something that shows up on their income statement. So in some ways, they're taking advantage of the fact that there's not a financial impact for maybe the negative things that they create off the balance sheet. But on the other end, for a social enterprise, sometimes they're creating social or environmental benefit, but they're not financially compensated for that. So one of the models to do that might be this pairing of a nonprofit with a for-profit. So you can begin to find some ways to get some value from that side. Another problem I think a lot of people are trying to solve is also, how do we, as investors, begin to step into this space? So our next speaker is David Wolf with BSW Wealth Partners, who's created a couple innovative investment models that kind of blend those values with your investments.
I'm also green to go. I'm also an investor in Impact Hub, so that was a great update on status of Impact Hub. Thanks, Rich. My primary role is as managing principal of BSW Wealth Partners. We're a wealth advisory firm, multifamily office with offices in Denver and Boulder. We manage about $900 million on behalf of about 200 families. About 50% of our assets have an explicit impact mandate. And the end result of meeting that impact mandate on behalf of our families, two things of interest. In 2012, I launched an impact bond strategy called R3 Returns that focuses on funding high impact municipal projects. So those are nonprofit organizations, not for-profit organizations. We've deployed about $125 million of capital since 2012, and we've beaten the conventional market benchmark every year since inception. The most recent thing that we launched that was, I think, pretty innovative last year, we launched something called the Private Market Impact Fund, which is a fund of high impact private equity, venture capital, and real asset funds. That was an initial $30 million capital commitment across the funds. We have 10 funds in that strategy now, with a plan in 2018 to do PMIF 2. So those are a couple of the things that we've done.
Thanks. Our next two speakers, I think, are creating some innovative models, which in my mind, as I've framed it up, that nonprofits in general are particularly now struggling to find predictable and consistent sources of funding, particularly in the political climate. The sources of funding from the government are expected to go down significantly. And in some ways, philanthropy is starting to pull back as well. So on one end, we have, in this whole ecosystem, nonprofits are struggling to find consistent sources of funding that they can count on. Every year, they're living and dying based on one big grant sometimes. We also have for-profits that are creating social good, but they don't necessarily see the financial benefit of doing that, or it takes a long time for it to show up. And then we also have investors that are personally driven by their values. So both of the next two folks are creating some ways that those three things can come together in kind of mutually beneficial way. So we'll start with Ted with Beanstalk Foundation. What some of the work he's doing.
So my name is Ted Stolberg with the Beanstalk Foundation. Margaret Cassard, our executive director, is over there. She may be able to answer questions. So here's basically the thing we're doing. It's community wealth building. Many of us are all working on that, but we're looking at it a very narrow lens, which is, wouldn't it be great if no privately held company in Colorado ever got sold outside its community again, right? Because we know what that means for community wealth. We know that. So what we're doing is we're buying private companies from sellers who basically don't need the highest price, because if they sell it to the highest price, it's going to be a corporate guy who has synergies, and we know what happens when you take the synergies out. People get crushed. Bad things can happen. So we're saying, look, we're going to give you a fair price. We're going to take care of your legacy. We're going to take care of your baby. We're going to take care of the people. We're going to keep the ownership, the cash flow, and the economics local. And ultimately, when we get our capital back plus, say, 8-9%, Then we're going to have the free cash flow go to local nonprofits. So it's an additional revenue stream for them. We did one, and Ed, we've got 5 minutes, so Ed's going to give me the hook if I go over the
You
line.
can talk a little longer.
Okay.
The other,
Okay, you
Dave was really efficient.
I know he was, so I'll take Dave's time. But he has a $30 million fund, so he doesn't. But we did one in Colorado Springs. We bought Mountain Equipment Recyclers, $1 million retail operation. The seller was in love with Kids on Bikes. Many of you may know that nonprofit down there. And so essentially, we bought it, and we merged Kids on Bikes operation into the store within a store. And it's kind of fun because it's two communities coming in, and it's it's working very well. And ultimately, that free cash flow will get our money back plus a reasonable return, and then that cash flow will go to Kids on Bikes. We will continue to do the corporate governance, take care of management, set up the metrics, and do all that kind of stuff. So it's just another model. It's kind of it's weird in a funny way. It's putting nonprofits in the private equity business, right? And think about the billions that have been made. So instead of some guy making get $20 million and buying an apartment in Manhattan, that free cash flow can go to some terrific nonprofit leaders. So, and it supports a local community. So I'm going to shut up.
You're still pretty tight. Yeah. Next we have Kelly Kiefer with Impact Lending Co., not LLC, Inc., not LLC. She's doing a somewhat similar model, but with generally with commercial lending, and also opening that up to additional investors. So we can't all do what Ted's doing. Maybe someday he'll open that up for others to join in and participate. But similar ideas of bringing those three kind of groups together to benefit each other.
As Ed mentioned, I'm Kelly Kiefer, CEO of Impact Lending. Jenny Hoff, my co-founder and business partner, is here as well. And we are involved in this conversation because we are joining business and philanthropy for exponential positive impact. So the way that we're doing that is we are creating a mission-driven lending ecosystem. And I hope you'll bear with me for the sake of conversation and for the sake of being respectful of time. I'm going to oversimplify a few things as I explain what we're doing, how we're doing it, and why we're doing it. I might also glance at my notes. Within this ecosystem, there are 4 different groups that we're speaking to. There are two groups with capital, and there are 2 groups that are in need of it. I'll start with the need. We believe that for-profit businesses, when they're successful, when they get the capital that they need, that it's good for everyone. It's good for their team, their employees, their family, their vendors, pretty much the economy and the society as a whole. But as you know, a lot of good businesses cannot get the affordable capital that they need. We also believe that when businesses are thinking about things like CSR, which is corporate social responsibility, they tend to be more profitable, tend to make better decisions, and it's also good for society as a whole. Also in the bucket with the need is what we like to call operational nonprofits. So operational or operating nonprofits are ones like the Denver Center for Performing Arts and the Red Cross and Project Cure, groups like that. I imagine that many of you in the room are involved in nonprofits like I am and have been on various boards, and the conversation that we keep having, and Ed and I were having this conversation the other day, is that the nonprofit fundraising landscaping is changing. I noticed that when I go to the black tie events and there's a silent auction, there are not as many millennials there as I would hope to see. A lot of groups will get a donation one year, and then the next year comes around and they're like ready for that donation, and it's not necessarily coming in again. So that is the side with the need. On the side with the capital, as many of you know, there's been almost $800 billion already donated to foundations, donor advised funds, impact focused 501c3s. And we believe that that money should be leveraged to do great good, whether it's a real return on investment for those charitable organizations, whether it's helping them with their PRI requirements or their MRI focus, or maybe sending some of those funds on to operational nonprofits. But the challenge there is that a lot of these organizations, even though they desire to leverage those funds for great good, they don't have the capacity, the tools, the expertise, the ability to find opportunities such as term loans to vet the deals, to structure them, to underwrite them. After the underwriting has happened, to track and manage these particular opportunities. And even when they do have the ability to underwrite and track and manage these relationships, that detracts from what they're supposed to be doing as a mission. It takes away from their day-to-day mission. And then there's a fourth group. The fourth group we like to call the crowd. So the crowd consists of investors, of individuals. And when it comes to the crowd, we found that a lot of the crowd, as mentioned a little earlier tonight, they're thinking in terms of either or. They're thinking in terms of, philanthropy. We want to help Fido at the local animal shelter, or we want to help Susie. Our friend Susie is making handbags, and she's doing amazing things, creating all these jobs, and she's using ethically sourced materials for these handbags. But Susie has too many orders to fill, and she can't get the funding that she needs in order to buy the new equipment. So we don't feel like it should be either or. We feel like it should be and. Why not do both? In addition to that, we believe that when the crowd is participating and when they're doing good things with their money, they should be getting a tangible tax write-off. If you're doing something charitable with your funds and you're parting with your hard-earned or hard-saved dollars, you should get a tax write-off for that altruism. So that's where impact lending, thank you for bearing with me on that background. That's where impact lending comes into play. We are a crowdfunding marketplace and a service bureau, which enables everyone to participate in business loans that drive donations to nonprofits. So the way that we're doing that is a for-profit business. They do not have to be a social enterprise. A for-profit business will come to us and apply for a loan. We vet them, we underwrite them. We are using the traditional 5 C's and we're adding a 6th C, which is corporate social responsibility, really screening them for ESG and net positive impact, things like that. And then we are packaging up this opportunity, putting together the terms, providing patient terms. So the capital, when I say patient capital, might be interest-only payments for the first year, a lower interest rate, and then we're highlighting their mission-aligned story. We're highlighting their, again, net positive impact. We are then listing this on our marketplace for syndication, where charitable funders, again, such as foundations, donor-advised funds, and the impact-focused 501c3s, and the crowd can come in and look at these different opportunities and really assess them according to their criteria. They can figure out what kind of impact they want to make. They can decide how much or how little they want to be involved. A larger foundation might take more of a particular opportunity, and a smaller one, or the crowd might want to just dip their toe in because maybe they're like, well, what is this impact investing world? And they're just exploring it for the first time. So also by participating out the opportunities, we're diversifying the risk for the funders, just like banks do. So then the loan is funded. It's as a service bureau. We're tracking it, we're managing it, we're facilitating it, we're making sure all the funds get to where they need to go. And then the principal and interest repayments, not only are we distributing those and making sure that the real return on investment is going back to where it needs to go, but we are able to track the impact down the road, and we're able to send, we have a revenue stream that is directed to operational nonprofits. So that's why we like to talk about exponential positive impact. We're impacting multiple points. A couple of things really quick in closing. I think I'm at probably 5 minutes and 15 seconds is, to be clear, we get asked often, we are not a CDFI, we are not a lender, we are not a fund, we are not a broker dealer, we are not a registered investment advisor. We are a crowdfunding marketplace and a service bureau. So there we go.
Thanks. All right, we're going to go ahead and start with some questions and answers. I have a couple that I'll start with while you think of yours. When we talk about impact investing, there's always a bit of our own personal values and our own emotions that are attached to it. Particularly for me, in working with donor advised funds, always viewed it as when you give the money away to charity, your financial relationship's over, but your emotional relationship is still there. So I wanted to ask the panel, for them personally, what drew you to this kind of work, and why did you start on it? Because in general, it probably takes a little more work than the other options of what you would want to do. You want to go first, Tim?
This is the why.
Why are you doing
this? Well, I worked at an investment bank in New York, and I spent 30 years of my life saying to myself that maximizing shareholder value was the first, second, third, fourth, fifth thing on the list. And then I woke up and went, oh my God, there's some really bad things happening. And so that was, and I won't bore you, but there's just 6 or 7 examples of where I woke up and went, my God, I'm a cog in this machine. And really, so that was essentially the why. I'm passing this on.
One of the first jobs I took was working for a company called Rodale Press. Anybody know Rodale Press? So Rodale Press, founded by a guy named J.I. Rodale. He's considered the father of organic agriculture. He actually coined the term organic agriculture. The first publication of Rodale Press was a magazine called Organic Gardening. And Rodale Press was a remarkably progressive and innovative company. This was back in the mid 1990s, and their headquarters is in Emmaus, Pennsylvania. So old textile country. They were going into old textile plants that had been abandoned, retrofitting them, making them corporate headquarters. I just was incredibly inspired by business as a force for good. And I think Rodale Press is an example of a B Corp before B Corps were cool, before you even had the term.
This is the why.
Yep.
Why do I do impact investing? Why do I do the Impact Hub? Midlife crisis. Actually, I hope it's pre-midlife because it was at 40. It was an early midlife because I want to live past 80. No, after a private sector career that provided some flexibility to me in both corporate and entrepreneurial endeavors, took some time to reflect, and I had started actually volunteering for an organization in Boulder. There's actually a chapter in Denver called Social Venture Partners. And I dove headfirst into local community issues. It was the first thing I'd ever done really philanthropically or civic-minded since I got on the corporate treadmill years ago, outside of writing checks to the United Way when our CEO would say we're not yet to our goal. And it just blew my mind, and it rocked my world. And I decided at that point that I was going to try to figure out how to use the gifts that I'd been given to try to make an impact on the world. And impact investing came about 3 years into that. So I went from kind of being a capitalist, pig, maybe, capitalist, trying to make as much money as I could as fast as I could. And then I went headlong into working shoulder to shoulder with organizations in Boulder County who were working with teen homelessness and a number of issues. And then I kind of became aware of impact investing. And I like to say that I had good perspective because I had the business background, but I had spent enough time working and consulting with nonprofits to not only recognize the tremendous asset they are to our communities, but also the significant limitations they have in terms of getting predictable revenue streams and really scaling. And so when I kind of came across impact investing, to me, it was just this epiphany, and not that I swung from one to the other, because we still have a family foundation and we do lots of philanthropy, but it's just this magnificent tool we now have to come at the market failures from 2 different perspectives and looking at it from both angles.
So I came to this with a background in several different things. I've been on the board for the fundraising arm of the Denver Center for Performing Arts for about 6 years now, and I've just seen the challenges that they faced and how that fundraising has changed over and over, and have been heavily involved in a lot of different philanthropic causes throughout most of my adult life. And similar to the conversation that's going on here, I've just found that the fundraising has become challenging, and I keep hearing that they're just working really hard to obtain these funds, and they're doing great things. And and we were personally impacted in ways. I have 4 kids, and my husband was in the ICU for a month in 2009, and I had 2 companies at the time, and I was just, the whole world was spinning and trying to figure out what was going on, and realized I was so grateful for the health insurance that we had, and the way that I didn't have to worry about that. But there are organizations like Project Cure, where anyone I meet, anywhere I go, I tell them about it, because they need more funds. And then on the flip side, the for-profit businesses, when I talk about a business being successful and we say that it's good for their team and employees and families and et cetera, the way that my family and I've paid our bills for the last 20 years is that I'm an artist, and I've spent the last many years commuting between Colorado and New York, mainly because I have 4 kids, so I live here. A little challenging to raise them in Manhattan. So, and a few years ago, I was going down the road of a capital raise. I'd already gotten to the point of I'd been talked into doing my own collection, and I had been doing commission work for about 15 years. And so I'd invested about 1.5 million of my own, and my CFO and I got together and thought, gosh, we need 2.3 more. How are we going to do this? And so we came up with projections and did the investor deck. And I was talking with all these at the time. I didn't realize they were true hardcore venture capitalists. And I was a woman-owned company that was high risk and low liquidity. And actually, when Jenny and I met, and I'm sure she's sick and tired of this story, but I said, oh, I know a little bit about your world, and I use the term EBITDA. And she looked at me like I was from another planet, because what artist actually knows that term? So but when my company was successful or is successful, that's good for my team members that are single moms. We're creating jobs. We're, my husband and I and our kids, we give of our time and our money to philanthropic causes. And even though that company isn't an impact company or a nonprofit, it's really good for society as a whole. But that was such an exhausting, frustrating journey. And I'm grateful for it in hindsight. But that's really, I thought, gosh, there's got to be a better way. And sometimes I feel like the people that are in the middle, where there's the, you can completely fund it yourself, or you have a great need. And then the people in the middle, my personal experience was it was just really challenging. And I made it through because I'm relentlessly persistent and persevere. But so that's kind of, I thought, gosh, how can we bring all of these different things together? And that's how we ended up with impact lending.
Thanks. So we've covered what and why. So I guess the next is how. So my question for all of them was that what were some of the difficulties you ran into, since in general, this is a pretty gray or cloudy area for a lot of folks. A lot of people aren't willing to step into this. Nonprofits tend to be a little scared about for-profit efforts. For-profits may be cynical about nonprofit efforts. So I just want to see, what are some of the barriers you ran into, whether it's culturally, operationally, were there legal questions? What kind of things did you run into that required some grit to kind of work through, or some collaboration? Give us any thoughts? Or I can ask David for specifically, as your firm's gone more into impact investing, what has driven that? Has it been more of your clients, or has your own group kind of expanded? And were there questions about return?
It's a two-way street.
Yeah.
I think we have a tremendous number of client families that are coming to us wanting to express their values. I think that that's very logical, that people want to express their values within their investments. And as that has occurred, even client families who've never stated an impact mandate, as they learn about what other people are doing, they say, yeah, that's what I want to do as well. And so you get a little bit of a positive feedback loop. Mm-hmm. So that's what we've seen internally.
Ted, I had the question for you. I don't know if I'm on the right track, but
Yeah.
in particular, negotiating with a for-profit and a nonprofit, how do you get all those to work well together?
Well, it's kind of, I'm going to say it a different way. Yeah. You're really in, like, think of yourself as a frog on 2 different lily pads, and the worlds are very, very different. I mean, I'm going to be dramatic, but, the nonprofit folks think the for-profit people who kill their mother for a nickel and they're greedy capitalists. And the for-profit world, again, this is for effect, but there's some truth in this. And the for-profit people look at the nonprofit and say, you know what? I'm sick of you. All you're going to do is ask me for money. You're going to ask me for more money. You're going to make me feel guilty. And then I'm going to give you money, and you're going to be back and back again. And it's a mess. So you really do. You kind of have these strange worlds. And the truth of the matter is that, this is kind of what we're trying to do, and all of you are trying to do, is bring the 2 worlds together. And they have something. The for-profit world generally has a business model and has processes in certain disciplines, but sometimes they're missing their contribution to their community. And the not-for-profit world has that in spades. They get all that, but sometimes they don't have, as Ed was saying, they don't have the sustainability, they don't have the business processes, they don't have the business model. So trying to bring those two together, I think is kind of, for us, the holy grail. And it can be done, but there are vast differences culturally between these two worlds. So we're always, running from one lily pad to the other and trying to translate. So anyway.
You have sometimes called it speaking both languages, or if government's involved, 3 languages.
Yeah.
Kind of knowing how everybody else
That's a
sees
good
the world.
point.
Yeah.
Good point.
Anybody else? We can go ahead and open it up to the audience for a few questions. Anyone has them? Feel free to ask the whole panel, or if you have one for someone in particular.
Questions?
I guess my question is, one of the things I've been thinking a lot about, so I got my degree 6 years ago in social enterprise. I think in 6 years, we've seen a lot happen, obviously, in impact investing. And I guess my question for you is, what is one of the most, interesting, innovative financing mechanisms that you've seen being able to be applied in this way? I think largely what we see is it's just not traditional methodologies. I mean, Ted, you just said something that was like, whoa, you just never really thought of it that way. So I guess I'm just sort of opening it up, like, what is one of the most sort of innovative, interesting things that you've seen in impact finance or impact investing and being able to drive investment in social goods forward?
One of the financing structures that we've used that I think I really, really appreciate, and I wish more people would use it. So the situation was a family that wanted to focus on sustainable agriculture. And there was a group in Maine that wanted to form a Maine Farm Business Loan Fund. So making loans to sustainable farm enterprises as well as up the value chain. And so we were able to identify a nonprofit group in Maine called Coastal Enterprises, Inc. So their expertise is underwriting, due diligence, and making loans. So the private investors were able to come in and provide the capital. And so the capital was going to be used to make the loans. But Coastal Enterprises, Inc. was going to provide a backstop. So they were the nonprofit. They weren't able to dip into their endowment and make the loans themselves. We were able to mobilize private capital for it, but private capital was willing to come off of the sidelines because CEI was willing to take this backstop position. And so I think that type of partnership between for-profit investors, or maybe market or market rate minus investors, and nonprofits can be super powerful in really mobilizing capital.
Yeah, I think two things. I think that the way that capital is structured now, like with kind of structured finance or having capital stacks. So more and more you're seeing foundations and philanthropic capital willing to come in to help provide maybe market or closer to market rate returns for other investors. So using, as our friend Jed Emerson would say, using kind of 0% money as catalytic capital to catalyze more and more for-profit funding. The other thing I would suggest is that just different types of investment structures too. I think, and I'm going to speak personally, but I'll speak to a number of folks that I invest alongside, primarily in Africa. But we started out kind of doing early stage investing in social enterprises using our traditional venture capital model, right? Convertible debt. The idea is convertible debt is to convert, and then you have some event that, where you get liquidity. And in some of the not all social enterprises, and I would say depending on where you're working, very few of them actually are going to build and grow like that. These aren't kind of your typical RVC, high growth, exit liquidity companies. So we've had to get a little smarter, a little bit more creative about different types of investment structures, structured exits, revenue-based financing. So trying to get better at matching the structure and the terms of the deal that really do support. Because most of us, we want liquidity. Like, that's the other thing. It's like everybody says, what's your exit? A lot of the companies that I've invested in Africa, like, exit? Like, what's that? A company that works on sanitation in the slums in Nairobi. But But we do need to figure out how to get, returns back. So I think there's been a lot around guarantees, things like that. Melanie and Jim are involved with MCE, which you mentioned, where you do personal guarantees to drive the cost of capital lower. So there's lots of things I think around how capital is structured as well as terms and to make these things work.
I just wanted to add one thing. At the end of the day, though, and I'm going to spin this a little bit, Ed, and I'm sorry, but no amount of structure will save us if you're backing the wrong person. So, that's the other, it's like, people before, I mean, we used to buy a lot of businesses, and I mean, if we had the wrong CEO in a great business, it was a disaster. If we had a terrible business and a fabulous CEO that built a great team and this, that, and the other, it always worked. So I just, it's good for all of us to remember. Well, and interestingly enough, women are better at evaluating men than men are evaluating men in picking CEOs. And it's interesting. Yeah, and I'm not even saying that to be politically correct. I'm just, honest to God, I mean, we were running these for-profit funds, and it's just interesting because, we're like, the guy played football for Notre Dame. I think he's a moneymaker. I like this guy. Telling you, I like him. And then we had this strategy. So we get wives and spousal equivalent to all these women, and we go out to dinner. And then after dinner, I would say, well, what do you think? And they'd be like, he's a jerk. And I go, what do you mean he's a jerk? Well, didn't you see he was kind of mean to his wife and he was doing this? I didn't see any of that. I didn't see, but so it's really kind of interesting. I'm not saying this to be politically correct. I mean, this is hardcore. You want to make money, you gotta pick good people, and you need to bring some other kind of thinking. So, sorry, distraction.
So going off of that, what do you look for when you're trying to pick good people?
We actually did a lot of work on this, and I want everybody to answer this question because it's kind of an art form, right? I mean, this is not but it's integrity, absolute great partnership. They give credit to their team, and when something goes wrong, they take the heat. It's never like, Joe screwed up. It's like, you know what? I didn't coach Joe and Susie right, and here's the problem. So they give credit. They actually get the connection between the factory floor worker, community, vendors, customers. They see it as a big system, and they share the wealth. The greatest managers we backed, it was fascinating. There was always an incentive plan, a bonus plan. There was all these kinds of things. And then the final criteria, if you don't remember that whole list, this was the one that saved us, was, and I want you to really think about this one. Would you, relative ages aside, would you like this person to marry your son or your daughter? And I mean, that cuts it differently. Because you can have some guy over here say, oh, the football player from Notre Dame, he's great, he's a moneymaker, I love this guy. And then it was like, no, I don't think so. No. So if you really think about that as a criteria, because you'll cut out a lot of bad actors, so it kind of makes it real. Anyway.
4 factors: ability and willingness. Do they have the technical ability to execute? Are they willing to do the job even when it gets dirty? Confidence. The next 2 are a unique combination of confidence and humility. So confident and humble. We call that confidumble. Confidumble. And then the 5th one that we typically look for is, has this person been able to achieve excellence in 2 very disparate areas of their life? So, for instance, are they outstanding as a business leader, but also football team at Notre Dame or something like that, right? So those are the 5 factors we look at.
I don't know if I can add to that, but my head's spinning. I got 4 daughters. I'm gonna have to go back and scrub my portfolio, I think. Golly. I won't be able to sleep tonight. I can't add too much. I think, tenacity is certainly way up there. After investing in a lot of early stage companies, and many of you do too, I tell folks the only thing I know about the business plan when I look at it is it's completely wrong. So it really is just how tenacious are they? How fast? Do they have an appreciation for cycle time and speed and learning as quickly as they possibly can? And then self-awareness, and it came through in some of the comments here, but they've got to really be aware of what they don't know, and the humility to actually reach out and find the folks around them that can help fill in the gaps. So that's a big one.
I feel like you guys have pretty much covered it. But going off of your comment of not knowing what you don't know, one of the things that we talk about a lot is looking for the no, looking for why will this not work? Why is it a bad idea? Tell me what I'm missing. Tell me. And I think a lot of times when people are willing to open themselves up, that way, that can be pretty revealing, and they're the ones that are going to learn and pivot and actually execute.
So we have a question from our live stream from Nigel. So hi, Nigel. And his first question, actually, Rich just addressed this with what he had just said about structures. But the second part has to do with how are companies with an impact mission really seeking strategic partners or potential acquirers? And is there any ethical decisions that have come up from companies you've worked with or invested in that have caused them to maybe not take a partnership or exit?
The classic case example that we go through, particularly at the university when we talk about some of our portfolio companies, was eco products. Everybody remember eco products, compostable cups, right? Well, so that material is made from PLA, which is polylinoleic acid. And polylinoleic acid is made from corn, but primarily from GMO corn. So there was a lot of internal debate about, hey, is this 2 steps forward, 1 step back? How do we think about it? Who's going to buy it? It ended up being purchased by Worthington, which is one of the largest distributors of styrofoam, right? There was another company in a fund that we were invested in that was sold to Pepsi. So how do we feel about that? It's now being kind of pushed through the Pepsi channel. So we have a lot of debate about that. And at the end of the day, I think we've been gravitating more where possible to companies that have more of a mission alignment where we can be more patient and look for an appropriate exit, or bake so much of the mission into the company that whomever acquires it, if they try and strip it out, they're going to destroy all of the equity value that they just paid for. Similar to Burt's Bees and Clorox.
We have a little trick. So when we buy the for-profit company, right? And let's say we've got our money back in the return. Well, now it's owned by nonprofit, and we're doing the corporate governance and we're managing all that. So let's say the day after the not-profit got the for-profit, let's say they said, oh, this is great, thanks a lot, we're going to sell it to Attila the Hun over here and make a lot of money, right? And so what we did, we actually got this we didn't create this, from Democracy Collaborative in Cleveland. So we have a veto right, which basically says, if you want to sell it outside the community, you got to come back and get our vote. And so we're not just trying to hold them up, but we want to have a discussion like, well, who are you going to sell it to and what's the plan? And so that's kind of a little twist.
It actually can start for an impact company, a really impact focused company can actually start before the exit. One of the biggest challenges for an impact company or a social enterprise is that there is no one impact investor. As soon as you put impact into the variable, everybody's got their own personal perspective on what impact is, what it should look like, et cetera, versus your traditional kind of tech high growth venture company. I might have an interest in clean tech, but beyond that, if the hockey stick has a slope of a certain amount, then I'm in, right? But as soon as you add impact, it adds all this other dimensions. So because I've actually seen this happen, when you get into the institutional rounds where the money comes with more governance, board seats and that sort of thing, the entrepreneurs really have to kind of really interview and the investor as much, due diligence on the investor as much as the investors doing diligence on the entrepreneur, to make sure, do all you can to make sure that there's values alignment on the investment side. In the developing world where I do most of my work, there absolutely can be trade-offs between kind of the depth of your impact and the level of return. You can, an easy thing, analogy would be, let's say, affordable housing. You could build homes at a certain price level to reach people living on $2 a day. The margins look a lot better when you sell to people making $10 a day, right? And I've seen companies who have started out with a mission that 75% of their inventory is going to be at, the $2 a day kind of a thing. Investors get in, and all of a sudden you see that start to creep up because they want higher and higher returns. So it can actually start higher than that. I don't have an answer on the exits. The debate about values kind of transferring on sale started when Ben and Jerry's sold to Unilever years ago. And you do the best you can. Etsy, I don't know if you guys have read that, but Etsy just recently got, taken over by a new management team, weren't doing well. The guys kicking their B corporation out the door, and they're like, we got to make money. So, but then you have White Wave and Danone. So there's, anyway.
Thanks. So I'm thinking back a little bit to the lily pad conversation and sort of this dichotomy of a for-profit mentality versus a not-for-profit mentality. And I wonder how you've seen the leadership, specifically I'm thinking about board positions, change and influence sort of that and traverse some of that either real or imagined tension. In particular, when employees or mission are trying to push some of the boundaries in either one of those organizations. As a nonprofit, I might be afraid I would lose my authenticity if I had a sustainable business model. And on the for-profit side, I might be afraid I'd lose my profit if I had an authentic sort of mission-driven mode. So I'm wondering about the leadership in particular around that.
I don't know. I worry about a lot of these nonprofit boards, I'll be honest with you. I think a lot of them are weak. And they're, and I don't know how else to say it. I mean, I think a lot of them are dysfunctional. And so that's a big problem. And in terms of losing your way, maybe if you're a nonprofit and you're trying to move to sustainability, well, no money, no mission. So I wouldn't be too worried about losing your way. I'd be learning about how you can continue to do what you do to make Colorado a better place to live. So I don't know. I kind of look at it that way, but I am very worried about these boards. I mean, how many sit on nonprofit boards? I mean, Margaret and I have a rule. We have 50 Colorado nonprofit leaders that we back and support and do all this other stuff. We have a rule. We're not sitting on any of these boards. I mean, the last thing we want to do is sit on a board and it's just inefficient. They're talking. People want to talk, and it's a mess. It's just a mess. I got to pass the baton.
Well, and I just wanted to add to that. One of the things that I think excites me most about evenings like tonight and this whole entire conversation is the idea of collaboration, and that I do see more nonprofits and for-profits having that conversation of why, we can have a business model and we can do good at the same time, and we can do good and get a return. And it's really fun to see these lines blurring, because especially in the nonprofit world, I feel like so often it's, we have this idea and we're super passionate about it and we don't really care if we just want to go forward. And the other thing that I've run into a lot recently is there seems to be this desire to reinvent the wheel over and over. Someone's doing something really good and they've poured their entire life into it and they just want to keep going with it. And there's another organization that will come along doing something that maybe if they collaborated, like we've been talking with Impact Charitable, that was one of our early on conversations, is how can we structure this as a win-win? How can it be good for everyone involved, for the economy, for the nonprofits, for the people, for everyone, and how can we make it a win-win, and why do we have to structure it any other way? So
that really triggered something. So think about this. When I talk to my kids, okay, so they're in college and through college, it's this next generation. And when I went through, because I'm a little older, I'm older than dirt. When I went through, you picked a path. You were going to either make money, or you were going to go in the nonprofit world and have a meaningful life and can't pay your mortgage and maybe not send your kids to school, right? That was it. But kids today, if you young adults, you think about this, and this is what I tell them: look, the world has changed. This is a fabulous thing. You can work for a for-profit company that's making a real honest-to-God contribution to their community. How about that? Or you can go to a not-for-profit that has a social enterprise or that's generating revenue, and you can make a living, support your family, and have a meaningful life. That's where it's, that's, to your point, that's where it's getting very exciting, and having this opportunity for these young adults. Got kind of carried away there.
All right, we can do one more question. We got John.
There's a lot of problems on this block, in this community, in our state. And as you fly around the world, they just get worse. They're everywhere. With the environment, with social justice, with economies that are not sustainable. What does this group do? Is there anything you can think of to allow these efforts and the impacts to scale? To scale.
Well, for me, it's all about creating very efficient and effective access. So part of the rationale for why we did private market impact fund is the vast majority of funds within that structure have a $500,000 or $1 million minimum. And so either people are going to put all of their money on Black 17 and sure hope it works out, or they're going to need a way to access those 10 different strategies that have very quantifiable impact, but do it in a way that fits within their personal portfolio, their personal allocation. So if you can digest that down to a $100,000 bite, people will bite. And then they'll do it again and do it again. So the idea of being able to go in and efficiently and effectively allocate capital and not be the Kresge Foundation. I think that's where we're going to start to see pretty momentous shifts in, because individuals are going to need to lead the effort, I think, in terms of mobilizing capital more broadly in the world.
It's kind of a good point. These problems are overwhelming, right? I mean, it's just like you wake up every morning, you go, my God. So the only thing Margaret and I and our team thinks about, the starfish story, right? Little boys walking down the beach. I don't know if you know. Like a little boy, there's been a storm, okay? Little boys walking down the beach, and all these thousands of starfish have been washed up on the beach, and they're all flopping around, they're all dying. And it's a horrible thing. And he's throwing this one in and this one in, and there's an adult comes walking down. You heard this story? The adult's walking down the other side. He says, "What are you doing?" He says, "There's thousands of these starfish. You're just a little boy. What can you do?" He picks one up and he goes, throws it in, and he goes, "Well, made a difference to that one." So it's, I don't know the answer to that question. You just get up every day, do your best you can, throw some starfish back, and see what the hell happens. I mean, that's all I got. That's all I got for you.
We're going to call this presentation Starfish and Lily Pads tonight.
I do think it's about capital markets. It's about changing the way that we view finance, investments. The real economy is just such a small percentage of the actual economy, where the finance economy, is at least 2/3 of, GDP around the world, which is absolutely, putting your money on Black 17. And it's the $1 trillion. And I have lots of faith in the generations to come who, as Melanie said, that we're coming up with generational wealth transfer. I know my kids aren't thinking about finance and investments the same way I did. They wanted to make a difference. So that gives me hope.
And I just have a touch to add. Similar to that story, that I love the phrase, many drops of water make the ocean. And I think that if we can just keep going, and one of the things that I really enjoy about evenings like tonight is that it does open up the dialogue and the conversation. And one of the conversations I've had several times recently is just the concept that impact investing can be a little intimidating. I was talking with someone that does quite a lot of investments on various different levels, and I just thought that they would be really comfortable, and they brought that concept up to me that it can be intimidating. And that's one of the first things that I said a while ago, was that everything's an acronym. And I was like, what's that acronym? Thank God for Google. But I just feel like that's one of the ways that we're going to get there, is by continuing to have these conversations and still keeping it very high level and informative, but also breaking it down a little ways where people that can, maybe grow up into these, have the ability to have more impact. They have to start somewhere. And so I feel like nights like tonight are good.
I just had another hit. You know what? Government is not going to save us. Wall Street's not going to save us. No one is going to save us. It's just us. That's the bottom line. It's just us. So don't hang around waiting for FEMA or somebody to come in and save you, right? And we just got to do it ourselves. That's the real world. So.
All right, thanks. Just a couple of thoughts to wrap it up. I think, as you might have seen, that I think impact investing is something you can do in every asset class and a pretty wide range of risk and return. So I think in a lot of ways, it's just the choice you make. And you can start small. You can start with an ETF. You can start, really simply just to begin to move money in that direction. I think that's some of my hope. And one of my favorite things about working in impact investing, about the last 5 years, I've been able to spend more time doing it, is that you do connect with some of the best people around. So the industry is full of good people. I used to do commercial real estate finance, and I'll say that industry is not necessarily known for great people. So that's one of the joys also of impact investing, is you get to hang out with folks like this.